It's the clear sign that the moment we've been waiting for, the intersection and the convergence of traditional finance and decentralized finance is happening. First of all, stablecoins are the object of that intersection, are the flashpoint, and so they're materialized. And the fact that they're growing, it's in itself a clear sign. It's measurable and quantifiable. And second, the fact that a company that has been one of the two companies, let's say, that has been successful at launching a stablecoin in the past 4 years goes public means that the public markets are now able to have a stake in the creators of the first flashpoint of decentralized finance into TradFi.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. My name is Simon Taylor. I am your host for today. I'm author at FinTech Brain Food and head of strategy over at Sardine. Joining me is my co-host, my friend, Cuy Sheffield, head of crypto at Visa. Cuy, how are you doing, my friend?
I am great. It's a big week for the space. We got a lot to cover.
Oh yeah, we're going to get into that pretty quickly. But joining us on today's episode is Sergio Mello, who is head of stablecoins at Anchorage Digital. How are you doing, Sergio?
Hello, friends. How are you? Good to see you here.
Really good to see you, my friend. It feels like we kept bumping into each other at various conferences, but now look, here we are in virtual presence talking stablecoins. Alongside him is Arnold Lee, co-founder of Sphere Labs. How you doing, Arnold?
Doing well. Thanks for having me. Really excited to talk about all things stablecoins and tokenization today.
Oh, and there's a lot. Before we get into the show, I just need to remind everybody that this episode is sponsored by our friends at BVNK. This podcast is sponsored by our friends at BVNK. And if you've been listening to this podcast, you've probably heard us say, every business needs a stablecoin strategy. And if you're looking for the best place to start, that's BVNK. BVNK is the leading provider of stablecoin payments infrastructure, helping businesses move money faster, settle globally, and even launch their own stablecoin products. All with licensing and compliance so you can build with confidence. We're proud to partner with BVNK on Tokenized. To learn more, visit bvnk.com. And just one last bit before we get into the sweet content we've got today, I need to remind everybody that views and opinions of contributors are their own and might not reflect the companies they're representing. Please don't take anything we say as tax, financial, investment, or legal advice. Do your own research, folks. Okay, the news absolutely everywhere is that a certain stablecoin giant by the name of Circle has filed its S1 and is set to IPO, targeting a $4 billion valuation. This would be the biggest crypto listing since Coinbase, and they're working with various investment banks like JP Morgan, Chase, and Citi. Some key stats. 1.7 billion in 2024 revenue, a roughly 39.3% gross margin, and an operating profit of somewhere around 157 to 167 million. One of the most fascinating things from the S1 filing is, of course, that Circle paid out $900 million of its 1.7 billion to its distribution partner, Coinbase. And there's so many other bits we could unpack here. But Sergio, I'm going to come to you. You're in the eye of the storm with stablecoins at the moment. What are your thoughts on news like this and more generally about the stablecoin space?
Well, first of all, I wish I could say that I enjoyed the calm before the storm in the past 4 years. It was definitely calm. It wasn't enjoyable, but finally the gates are open and off to the races. So this IPO is a fantastic moment for the industry. It's the clear sign that the moment we've been waiting for, the intersection and the convergence of traditional finance and decentralized finance is happening. First of all, stablecoins are the object of that intersection, are the flashpoint, and so they're materialized. And the fact that they're growing, it's in itself a clear sign. It's measurable and quantifiable. And second, the fact that a company that has been one of the two companies, let's say, that has been successful at launching a stablecoin in the past 4 years goes public means that the public markets are now able to have a stake in the creators of the first flashpoint of decentralized finance into TradFi. So it's all coming together. This is really the core central piece of the puzzle. When you have a big feature and a puzzle, and there's one the eyes of the main character that is missing, and then when you finally click the piece in, this is that moment. So it's a fantastic moment for the industry. I have a few more comments about it, but generally speaking, it's positive. What is interesting about it is that it introduces a level of transparency on one of the creators of the stablecoin industry, and that is also great because it gives the opportunity for all the contenders for the space, which is $1 trillion space, to see how it works and see the mechanics. And as you highlighted, Simon, the most interesting part of it is that the money in stablecoins is in distribution. It's not an issuance per se. Issuance is a mechanical, very delicate and should be regulated operation. It's critical, but really the money is not there. And speaking from a bank perspective, I can attest it's a bit like the banks, right? Custody is incredibly important, but it's hard to make money on custody only. Really, where you make money is on everything that stacks before and after custody, payments, lending, etc. So it's a fantastic moment. It's really something that we will remember in the history of finance as the catharsis.
All right, Cuy, big news, of course, this week, the Circle S1 filing. How are you finding people are reacting to it? What are your thoughts on this more broadly?
I think I agree with a lot of what Sergio said. I was kind of approaching it from the other lens that is stablecoins are fundamentally a new product. It's like a new construct that hasn't really existed in the world of TradFi and fintech for very long. And I think we've gone from 12 months ago, there were many people in traditional payment companies and banks that were either disinterested or had dismissed stablecoins and thought they weren't going to get regulatory clarity, or maybe they would just become a niche thing in crypto. And so they hadn't really rolled up their sleeves and spent a lot of time to understand them and figure out kind of what are these things as a product, how do they work, where's the demand coming from, what are the use cases. And so I look at the S1 as a fantastic opportunity and really crash course for many traditional finance investors, operators, payment companies that get to kind of look under the hood of one of the largest stablecoins with, as Sergio mentioned, a lot of transparency into what does the business actually look like. And I think there are a bunch of really interesting takeaways and implications from that. But I can't think of a better place to start and just source of information if you're inside a bank or a fintech or a payment company and you're saying, okay, let's understand what these stablecoin things are. Like, go read the Circle S1. It's like, it's the best information that we have. That's like a view into what is a stablecoin, how does it work, and like I think that's going to become very helpful in getting a lot more people up to speed on the space and a forcing function for them to do the work. When you've got a public company that's coming to market.
Yeah, there's so much to crawl through there. Arnold, have you had a chance to look at any of this, and what were your thoughts?
Yeah, not a chance to look deeply, although I've seen some of the highlights and broadly agree with Cuy. I think it's still a very nascent sort of like transition period for institutions who are more used to thinking about these filings and like the traditional breakdown of how much revenue relative to like OpEx this company is doing. But I thought it was like super interesting that the step function that happened during the last cycle for Circle's revenue. And it kind of to me speaks how wide the ocean is or how big it is when it comes to just adding more supply. And kind of to me, the unfair advantage of Circle is Lindy. You can like create a new stablecoin, but to get it integrated into all these different chains, all these different ecosystems, when you have the addition of a lot more people, say another step function with another cycle adopting stablecoins, I think that's like hard to capture in their current financials because it could be quite the step function, and translating into a corresponding increase in revenue. But as of the world today, it's been pretty interesting to hear about some, I suppose, things that you wouldn't expect from a stablecoin issuer at that size. And I think transparency is super helpful for the industry, even for those who, might be jumping in after recent news in the last year, whether on the acquisition side or just like general regulatory clarity.
Yeah, it's a fascinating point you make that really this S1's looking back at last year and the growth has been coming and a lot of that would shown up in Q1 and Q2 for them. And, there's momentum building there and there's a distribution advantage. But that distribution is expensive. They're having to give away kind of a lot of revenue. And then, yeah, as you said, the staff cost is pretty expensive. These are not cheap resources. They're all onshore. There's a lot going on here. There's a really interesting line in the S1 that Circle estimated a 1% decrease in interest rates could result in a $441 million decrease in stablecoin reserve income. So even if the total volume of stablecoins goes up, they are very, very rate sensitive. Do you think that sort of model, Sergio, of like relying on rates is kind of gonna survive? Is that going to be the core monetization route for stablecoins in the future, or are we going to have to see a bit of a diversification there? And if so, do we need regulation to help?
This ties into what I said earlier, that the money is in the distribution, and the issuance layer is as delicate as it is hard to monetize, which puts stablecoin issuers in a difficult spot because they really have to decide how to structure their strategy to make sure that they're sustainable for the future. I am convinced that it is possible that in the near future, regulators will accept that the currently accepted HQLA mix for a stablecoin reserve may be slightly expanded with a slightly different risk profile. Ultimately, what we want as stablecoin users is an instrument that is as close to risk-free as possible while allowing us to settle instantly on the internet. And it's a compromise in any case. So look, if the compromise bar has to move a tiny bit just to make sure it's still a profitable and usable and a convenient tool, I don't see that as a problem. So if rates go down to 3, 2, 1, I think we can adapt for that. If they really go to 0, okay, we will have to reconsider. But this is not the moment to make such prediction. It's the moment to understand that the money for a stablecoin business comes from the layers above and below issuance. So it's about making sure that there's a scale, because again, Circle today is at 50, 60 billion. If they were at 500 billion, it'd be 10 times the money. So that's how we solve the problem in one way. And second, as we are talking about step function growth, we have to understand that this new inflow of capital, differently from the past 6 years, will not come from more people lending and borrowing on DeFi, but will come from traditional finance money, M2 money supply that will, instead of circulating on Swift and traditional rail, will circulate on chain. So this will be 10, 20, 50, 100 times faster growth that we've seen in the past 4 years.
Yeah, so I think to your point on scale and back to your question, Simon, like I think it's very clear that a decrease in interest rates leads to a decrease in reserve income if the supply holds steady. However, I found it interesting that multiple times throughout the S1, they pointed out that it is really, really difficult to try and predict what the connection between stablecoin supply and interest rates are going to be. What impact would lowering interest rates or raising interest rates have on supply? Because there are many different factors. And so, they point out, maybe if you lower interest rates, then the opportunity cost of holding, something that feels like digital cash that is not interest bearing goes down. And so then the supply goes up, or you could have a scenario where, interest rates could go up, but the supply could still go up, because there's enough demand and utility for how the money moves. And so I think that is one of the most important questions for investors in how big could USDC and stablecoins in general get? What is that total addressable market for supply? Because I think most people would assume that interest rates will come down. It's just a question of, will the supply growth outweigh the kind of lowering interest rates on the kind of per dollar amount they make on the reserves. Arnold, curious how you think about that.
Yeah, I think it's super hard to reason about, as you mentioned, because say rates go down, then it's really attractive beyond a store of value to hold money on chain because the industry has very high beta assets. And so if interest rates go down, people need to figure out where to park their capital. One could reason that maybe they want to put it into ETH or into Sol or start using DeFi because that level of return is hard to get elsewhere. I think we'll kind of see this experiment play out just because a lot of the adoption has happened in like historically low rate environment, and then like the switch flipped to these rate hikes, enabling these order of magnitude increases in revenue for companies like Circle. But to Sergio's point, I think the really interesting thing for like beyond issuance will be the order flow and sort of like the breakdown of where that order flow happens. When you have these proxy dollar accounts that like people couldn't historically get access to, the way that they transfer the money, like correspondingly, is really difficult to reason about because someone in Brazil might not have access to transferring flow in a way that a market maker would be able to get exposure to in the traditional fintech.
Huh. There's such a multivariate, complex set of conditions, and I think, Cuy, to your point, the Circle were quite honest about this in their S1, that it's going to be really difficult to figure out kind of what happens next. I loved the point that Sergio made about reasoning about these businesses as custodians, and that custodians don't make much money from the act of custodying the assets. It's the workflow around it. And there are sort of a number of evolving models and a number of competitors now starting to look at, whether it's an offshore one that's doing yield bearing or whether it's doing sharing the economics. And, then there's USDE, the fastest growing stablecoin in history. There is this experimentation now coming kind of from the bottom up. So it is a difficult one to kind of consider. From my own perspective, the thing I like about this more than anything is the story of Jeremy Allaire. Like, this is a guy who is a multi-time founder. So his first startup, which was named Allaire, was acquired by Macromedia and became a big part of what went on to be Flash Player. So before YouTube, before Netflix, we had Macromedia Flash. He was deeply involved in that. And then Bright Cove, one of the pioneers again in internet video. And then being early was kind of the consistent thing that happened. He's early to online video. He's early to monetizing online video. Is he too early to exiting for stablecoins here? And has the market kind of changed? So I wonder about what happens next, especially given the news today on tariffs, how this IPO is going to play out. It's going to be fascinating to watch. Arnold, I'm interested from your perspective. Are you seeing kind of any change in appetite for adoption of stablecoins given the headlines, or is it more fundamentals from your perspective in that it's really more demand driven?
Yeah, so I just got back from Argentina, and I know like sort of the meme is that everyone knows what Tether is, and like everyone's just using stablecoins all the time. But what was fascinating is that, at least from what I saw in comparison to last year, last time I was there, is that people still don't really know that much about stablecoins if you think about it from bottoms up. Like the most adopted apps for retail like still emphasize these as just dollars. And to the average person, it's a proxy for having a bank account where they can get those dollars. But if you add like a letter at the end of the USD, it'll probably confuse people. And so, I think the introduction of things like tariffs, frankly, is quite interesting from like a currency volatility perspective. We've seen like order flow kind of deviate away from, using USD, I don't know, for like internal reconciliation as an example. If you're doing treasury ops across multiple countries, you might have historically held more balances in COP, but now holding in USD is super attractive because who knows where the volatility will go, and USD is just like a better unit of account, even if you're an international company. I think it's generally good for flows and like the total volume of flows, even though it's like probably bad for economies. And it remains to be seen what like the net effect will be. Like does like a reduction in trade activity or like general economic depress mean that like people are just going to interact less across borders, or does it mean that the pain points of moving money in and out as like supply chains get rearranged? Like historically, if you're manufacturing outside of the United States, now you need to bring it back in-house. You need to pick like a brand new vendor set of who to use for like raw materials or processing. And I think any flexibility in terms of rearranging your capital is like quite helpful, especially if you can do it fast. Otherwise, like the ship will just like stay on the shore for 5 days waiting for the thing to settle.
Okay. Can I interject and add on Arnold's remarks about Argentina and financial freedom? I think there's a misconception about financial freedom and how cryptocurrencies and Web3 is empowering financial freedom. And the best way I have to explain it is freedom of speech. Freedom of speech doesn't mean that the four of us every day go out in the street and yell insults to everyone. It means that we have the option to do so. And the way the Web3 is empowering financial freedom in the world is it gives the option of self-custody, of privacy, using privacy coins, etc. And the optionality is what drives innovation, what drives adoption of new technologies by incumbents, etc. Stablecoin being one of the first in that direction. So, Arnold, you're correct that people want USD. The letter at the end is a distraction that 99% of world population don't need, is probably not ready to take, and probably is actually detrimental to overall experience. So my strong view about stablecoins is that they are and will be more and more used as the layer just before retail, that goes all the way covering the financial stack because of its performance in moving and storing value. And but then the retail application is the moment where users don't necessarily have to be exposed to self-custody complications, let's call it, and deciding on which type of USD or which type of other stablecoin to keep.
I love that perspective. Payments, as somebody 20 years in the industry, always felt to me like they have a last mile problem. Like I can probably get through the hubs, but I can't get to the last mile. Stablecoins get you to the last mile, but not the front door. The front door is the retail application. So kind of having that rail above the rails, having that sort of universality of stablecoins is a powerful perspective. And then you still need that end application, that thing that the user looks at to think about the user experience. I think this is why Sling Money's done particularly well. They haven't advertised PYUSD as being the US dollar. It just so happens to be there in the background, and their growth is spiky. Well, from public markets to publicly thanking sponsors, we'll just take a quick break here and hear from the folks that make Tokenized possible. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is brought to you by Canton Network. Ever wonder where real tokenized asset volume is going? Canton Network. The groundbreaking layer one public chain where traditional finance and crypto are starting to converge. Why? Because Canton is the only public network with privacy. No workarounds, no compromises. This is 24/7 markets, on-demand financing with real yield, where value moves as freely as information on the internet. This isn't just another blockchain. No, this is where the serious money is flowing to solve real market demand and risk. Visit canton.network to learn more. Okay, so the next story was from actually BlackRock's CEO letter, where he talks a lot about tokenization. His specific quotes here are tokenization makes investing much more democratic and much more efficient. It allows for fractional ownership. It allows for democratization of shareholder voting. It potentially democratizes yield by stripping away a lot of the legal, operational, and bureaucratic paperwork that gets in the way and adds cost. And he says quite bluntly, every stock, every bond, every fund, every asset can and probably will be tokenized. And if they are, it will revolutionize investing. Markets wouldn't need to close. Transactions that take days would clear in seconds. This is quite a lot of space in an annual letter from the world's largest asset manager dedicated to tokenization. Is this just positioning for what's to come? You know, BlackRock has been known for positioning towards ESG and then maybe sliding away from it. Or do you think that actually, given Franklin Templeton and others are getting involved here, that actually institutional DeFi has finally arrived? Sergio, what are you seeing? What are you hearing?
You know why it's really hard to make a comment? Because it's April 3rd, the day we're recording. And I'm pretty sure that by the day this is published, there's going to be more news and more and more. And so the pace at which all of this industry is moving is accelerating. And making not prediction, but making comments during a hockey stick phase means that your comment is outdated by the next week. That said, it's amazing that the fact that we can finally have a clear path technologically and partnership-wise to bring real-world assets on chain is fantastic. It's phenomenal. From T-bills to gold to artwork to real estate, making a world a more inclusive place where you have the option, connecting to what I said earlier, to access any sort of asset anywhere in the world at your fingertips. What we need is a little bit more regulatory clarity. So really hoping for the market structures bill to have a good bipartisan support and proceed as fast as we've seen the stablecoin bills proceeding. That would be really the gift to mankind, because that will allow everything to happen happily and without the drama we've seen in the past 4 years. At Anchorage, we're already supporting BUIDL custody. BUIDL is a very successful product by BlackRock. The one metric that I think we need to keep in mind is that today we're looking at hundreds of billions in stablecoin issuance. We're looking at low-digit trillions in total crypto asset market cap. As soon as the tap opens, as soon as we start having real serious tokenization of securities and stock that will flow without friction from traditional markets to blockchain, those figures will add 2 or 3 digits. Mark my words, 2 or 3 digits is a lot.
Yeah, I love the prediction. Like in general, I think you have to give Larry Fink and BlackRock credit that like they're not just saying this now. They've been consistent for I've lost track of time, but it hasn't been a few years of Larry Fink was talking about tokenization and Bitcoin when it was not popular from a regulatory perspective, when it was much less clear from a regulatory perspective than it is now, even though there's still a long way to go for them to be able to realize that vision. I think it makes a lot of sense, that particularly if you think about if tokenization can lower the barrier to entry to creating new financial products, that could be more customized and more tailored towards certain investors. That seems like a huge opportunity for BlackRock. And I'm no capital markets expert, but like I don't think it's easy to create ETFs. I think there's a lot of work that goes into that, and it's not to say that tokenization solves all of that. But if you have a technology that can replace manual back office processes that could reduce any amount of the cost to create a new investment product, then you could have more investment products, and you could have more customized, more tailored, more niche investment products towards investors based upon what they want. And I think that's a really big deal. So I always approach it from like, it's less interesting or exciting to me to just say every existing stock today is going to be tokenized and on chain. And like, yes, I think there are structural 24/7 settlement things that that might be able to address. I'm more interested in like, what are brand new investable assets and financial products that could be structured and created that would be very hard to do, that you don't have access to at all today. And maybe there's not enough demand to justify the cost to create a full ETF around it, or maybe the underlying assets aren't liquid enough or able to be moved. So I think that there's just a lot of innovation that it unlocks for a company like BlackRock. And then when you've got Robinhood on the other side, the most innovative retail brokerage, saying virtually the same thing, it's really powerful to hear kind of both of those voices at the same time.
It's almost a three-body problem, right? You have the tokenization, the tokenized asset coming on, the stable coins solve for the cash leg, and as soon as you have the liquidity for those two, then the third one, Cuy, so the innovation part, the new products, can finally find a fertile ecosystem with native liquidity. Today, it's hard to launch new products on chain that don't exist on TradFi, because there's no buyer, there's no liquidity, there's no momentum, or there's very little, at least. We're at the very beginning, right? So as soon as we add those 3 digits, poof, everything is in place.
Liquidity begets liquidity. Arnold, thoughts?
Yeah, I think definitely from first principles, cheaper, faster clearing, settlement. It's a no-brainer, and it's like kind of like shifting the internal DNA to get on board with what has a lot of extra stuff attached, because it's like in a permissionless environment typically on chain, and regulatory clarity I think would make a big difference. We're developing like a regulated sort of like focused version of Solana at the moment, and GSIBs, asset managers that are similar in profile have shown like a surprising willingness to allocate resources and start thinking about, hey, like what are the ways where we could actually experiment with this stuff. And if we like look to the example of like futures getting created way back in the day as a way to like hedge against agricultural exposure during differing seasons, it's fascinating that like we've created staking as an industry, or variations of like conditional escrow. And in traditional markets, you would have to have like a special plan, a structured product. And if I were Robinhood or Citadel, I'd be like super interested in sort of like getting exposure to the types of commercial activity that it normally operationally would be like super annoying for me to access. As an example, in Brazil, there's like a 90-day period for a creative, and that might seem like a pretty small industry, but you can think of an analog as like oil and gas, and sort of like repayments for international investors and some of the largest shale reserves in the world. There's just so much bureaucratic red tape that has historically been a way to enforce trust fragmentation between different peer-to-peer ledgers, these different silos. And I think that if I were a sophisticated financial institution, being able to both create a structured product programmatically, where you can really go into the weeds of how the business logic composes on top of each other. Maybe like the first leg is conditional escrow. Maybe the second leg is like, hey, there's some verification of a counterparty's quality or of their certifications or approvals. And then this allows us to underwrite, say, a typical 90-day pay period for a creative out in Brazil, but bake it into what is effectively factoring without having to produce 100 pages of paperwork just to be able to underwrite it and clear it with my local regulator.
It grows the TAM of financial markets quite dramatically, doesn't it? When you start doing that sort of thing, to Cuy's point, which is what will be those new financial products. What's interesting in your comments, Arnold, is the serious work by large institutions on networks that they would have never touched. I was head of crypto R&D at a bank in 2015, and everything was, we like the technology but not the currency. And then, of course, when we get a Bitcoin ETF, it's like, sure, we'll trade that, but we're going to build like permissioned ledgers. And what's happened since then has been just a gradual walk towards the inevitable, which is what makes these networks special is network effects. And what allows you to drive workflows and contain this logic is inherent to the network and the network security model. And so that baking the logic into the network and giving you the ability to write these workflows that don't necessarily need to know who the counterparty is to have cryptographic proofs without having to go out of bound of the transaction and go to the legal framework and the paperwork is enormous reduction of that bureaucratic red tape that you talk about. That's a phrase that people say, but they often don't ground it in something tangible. Cuy, you were going to jump in?
It's such an important point. And even going back to the last story, just like take the thought experiment of what would Circle and USDC look like if it only ran on a permission blockchain? And if you actually think through that, you're like, okay, so Circle in their S1, they said there are thousands of entities that are wallets, that are applications, that are protocols that have integrated and used USDC or make USDC available. So then now that would have meant for Circle's business, they would have built a ledger that then they would have had to onboard and directly integrate with several thousand entities for them to be able to use USDC. Like it doesn't work. And now it looks like a pretty traditional centralized e-money business that's very hard to scale to thousands of third-party integrations. And so I think part of the magic of what enables stablecoins and the value of tokenization is Circle was basically able to issue a product across 19 public blockchains, of which are open sourced infrastructure where they're actually the cost of running and maintaining that is distributed across thousands of nodes of individuals and entities. So Circle's not paying the cloud hosting costs for Ethereum and Solana to be able to run. And then the integrations in terms of a company being able to use USDC is an integration with a blockchain, rather than an integration with Circle. And so the ability to outsource that ledger integration and infrastructure, whether it's for a stablecoin or whether it's for a tokenized asset, to me is the really big deal. That if you just take all of this and say, no, there's going to be a permission blockchain that's going to be run by one entity, you don't have any of the value on it.
And I think people don't get how big of a deal that is, right? Like Mike Hudak said it way back when we had him on the show. Like, people don't get how big of a deal that is. That's such a big deal. And for my sins, I was one of the folks originally in the mid 2010s pushing the shared ledger concept, because like I was trying to land that point, but I think it got waylaid a little bit. Sergio, sorry, I cut across you.
No. In other words, it's an outsource of trust, and it's something that it's hard to comprehend, but also it's hard to explain in a traditional risk model and bank compliance framework. That is the challenge today, I think. It's obvious that there's money. It's obvious that this is the direction. It's obvious that we're all looking in the same landscape and facing the same way. But some players, some incumbents, will actually face a lot of internal challenges in making that leap based on their current architecture and policy and culture, frankly. Anecdotally, I was speaking to a large financial institution no longer than a few weeks ago, and their idea was to KYC every single holder of potential self-issued stablecoin. And to which I said, well, look, and in this, I also need to bring in Tether to the picture, because we're talking a lot about Circle, but there's two companies that paved the way for all of us here to be happy about the future of stablecoin. One is Circle and one is Tether. Tether has, according to them, 500 million active wallets. Good luck KYCing 500 million people with a single centralized infrastructure. That wouldn't happen. It's something that couldn't have been done before. So, and again, back to the distribution. distribution is only scalable because blockchain allow to outsource to the ledger the trust part.
Yeah, and the accounting treatment plus the BSA AML treatment of cash is very different to the treatment of kind of like a bank account. And I think people are confusing those two things quite dramatically. Digital cash is a different beast.
Rightfully confusing, because what are stablecoins? A fusion of a treasury instrument and a payment instrument and cash, right? It's like cash plus a money market fund. So it's understandable that people would confuse how to treat it. And it's beautiful because those who can navigate the waters quickly, nimbly, fast, and get to market and find the right way to do it, sometimes taking risks, sometimes waiting for the regulation to clarify it, will reap enormous benefits.
I'm going to come back to that clarity on regulation point. I did just want to point out, I don't know if you guys saw it, that DTCC announced their platform for tokenized real-time collateral management. They've launched an app chain, which is infrastructure to support the institutional decentralized finance movement that's starting to kick off. And I think they don't announce that they're going to put this out there unless there's demand in their client base, and it's built on the Besu blockchain. So I think that's part of the kind of EVM family. So there's definitely a movement there that you can see these things coming. It's slowly then suddenly, and people are lining up, and regulatory clarity might come sooner than we thought. There's another bit of news coming out of now after the OCC a few weeks ago, the FDIC, the Federal Deposit Insurance Corporation, says banks no longer need to seek a no-action letter in order to engage in crypto-related activities. This rescinds a 2022 notification. Of course, there is a caveat that, of course, all activities should be conducted safely and soundly. And you can see why they had to say that. This is in the shadow of SVB and in the shadow of Silvergate and Signature and a lot of banks that were kind of exposed to and quite close to the last crypto market cycle. Arnold, is this helpful in that broader narrative around regulatory clarity, or are we not there yet until we get some sort of bill passed?
Yeah, I think it's definitely helpful. And, just like how, companies have, or maybe fintechs have their own risk spectrum, so do, it goes way up the stack to financial institutions. It feels like at the tippity top, regulatory clarity through an explicit bill would be like kind of the game changer. But it certainly doesn't hurt to have guidances issued like the one above, just given sort of like the implied takeaway from what's in writing, and the majority of stuff is probably verbal or like in conversations in person, so it's a really nice change, I think, but we still have ways to go. It feels like before everyone feels comfortable, say, issuing, migrating their core flows to on chain.
People forget that so much of what happens between a financial institution and its regulator is a conversation behind closed doors that isn't necessarily published in guidance. And I think there's a lot of financial institutions still worried about, okay, yes, we're potentially happy to dip a toe in the water here. I can see the encouraging signs, but what happens when the administration changes in 2029? So your point there about the bill is like, actually, I need the bright line rules to kind of really, really help. Is that resonating for you, Sergio?
Well, we've been in an island storm with Anchorage. Anchorage Digital owns the Anchorage Digital Bank, regulated by the OCC. It's the first and only U.S. national bank with a specific crypto charter and activities. So ever since the January 2023 joint letter from Fed, the FDIC, and OCC, effectively there has been a ban for all financial institutions to get entangled with crypto. I mean, it has been particularly difficult. And what we're witnessing now is a snap back in the right place moment where all of a sudden, within the span of a few weeks, things are normal and banks can be seen interacting with digital assets without having regrets. There's no explicit prohibitions otherwise. So there's no reason why why institutions shouldn't use new technology to deliver their services. Of course, proper market structure law would help, but this is another debate and opens a whole can of worms that probably is beyond this this podcast. We should have another episode for that. But there are ways to interpret current market structure activities, and simply mirroring the ways that that's working in current traditional finance for crypto would already be a safe and cautious way for financial institutions to deal with it. Now, we can improve it, and that's why there should be a healthy debate about a market structure bill, but abiding by existing standards already sets it up in a nice way.
It's not a bad place to start. Cuy, any thoughts?
Yeah, I mean, when I've spent time talking to banks, really beginning of this year, as the interest and momentum towards stablecoins and digital assets was ramping up, and I'd ask them like, what are the biggest barriers for you to even just get started and develop that strategy and come up with a plan and start to execute it. And what most of them cited was, well, the OCC, there's a non-objection requirement, and that's a pretty high burden if you have to go and seek non-objection as part of your early stage product research development process. Like that's a very high bar. And then the FDIC, with a similar request for non-objection. And so I think getting the OCC updated guidance last week or 2 weeks ago, we covered it on last show, and then now the FDIC, we're starting to see just more consistency across the banking regulators, that it's not to say do whatever you want and like ignore the risks. It's to say that like you're a bank, you're responsible for managing risks in anything that you do, but there's not a separate process where you have to seek non-objection before using one type of technology versus another. Which I think many banks struggled with. That basically just destroyed the case to make to invest in it internally.
Yeah, it wasn't an outright ban, but it was effectively you're going to have to crawl through glass and in hell in order to get this done. And is that the battle you want to fight right now? Well, that is a nice place to leave it. Regulatory clarity may be coming soon. We're hopeful for it, if we can just make it through the macro to have an economy left in the process. But that's all for this week. I want to thank you so much for listening, and viewers for watching on YouTube. Steadily growing audience. Thank you guys for tuning in. I appreciate it. Sergio, where can people find out more about you and Anchorage?
Anchorage.com is the bank website, and I am Sergio Fly on Twitter.
Arnold, how about you and Sphere?
On X at Sphere or at Sphere_labs. Website is spherepay.co or sphere.net, and also on LinkedIn as Arnold Lee.
Phenomenal. Thank you so much for joining us. Cuy, how about you?
On X at Cuy Sheffield and visa.com/crypto.
You'll find me at SY Taylor on Twitter, or Simon Taylor on LinkedIn, or sardine.ai, or even fintechbrainfood.com. If you haven't already, go ahead and hit subscribe, do the like button thing on YouTube, do all of the above. It really helps others find the show. We'll catch you next time.